Ladies and gentlemen, people of the internet, welcome back to yet another episode of Crypto Over Coffee. I hope you're doing well today, and if you're new here, every Saturday we break down the latest news and the hottest topics in the world of technology and cryptocurrency over a cup of delicious coffee, but today it is 7 p.m., so we're having a beer instead. Now, that being said, in today's episode, I'm talking about the make or break time period for Bitcoin and crypto that we are entering and how you can prepare yourself for whatever happens. We're going to talk about crypto regulation. We've got our usual 404 Logic Not Found segment and a ton more, so make sure you stick around for all the updates we've got in store. Now, if you like crypto, please do subscribe to the channel, hit the bell notification button, or you can follow the podcast on your platform of choice so you can get a heads up whenever I post new episodes of Crypto Over Coffee every single weekend. And better yet, if you are a subscriber or a follower and you leave a comment on the YouTube video, you will automatically be entered to win a weekly random draw for a Keystone Pro hardware wallet or a Keystone seed phrase backup device every single week. And finally, just a friendly reminder, which I wish I didn't have to make, please be aware of scammers across all social media that are pretending to be me. You got Instagram, Twitter, Telegram, WhatsApp, spamming my email, spoofing my email. They're trying to take money and personal info from you. I will not reach out to you. I will not ask you for money. And if you get a comment on YouTube asking you to contact me on WhatsApp, it is not me. You can report it. Please be safe. All right. Now, the title and the intro of this video pretty much says it all. But we're entering a make or break period for Bitcoin and the rest of the crypto market as we approach the reality of rate hikes, global conflict, and regulatory scrutiny, and the confluence of all of those events together. With Bitcoin having dipped below 40,000 yet again, and the rest of the markets going red in the wake of another shockwave of unease in the markets, it's becoming clearer and clearer that we are in the midst of a pivotal time period for crypto and really other risk assets like equities, for example. As we've talked about before on this show and in weeks past, when the Federal Reserve in the US hikes interest rates, it makes risk assets like Bitcoin and cryptocurrencies and stocks, etc., less appealing to investors. And speculation around the first of several rate hikes this year has already caused a major sell-off in both equities and crypto so far in just the first couple months of the year. Rampant inflation is forcing the Federal Reserve's hand here, and that's no surprise, but it's a no-win situation. Do you hike rates and stop the money printer, but tank the economy in the process? Or do you accept the inflation and rising cost of living and just keep on moving on? It's not all that simple, but still the fact remains. It's believed that the first of potentially 4 rate hikes that could come in 2022 may come in March, which could be a make or break moment for what this year holds for Bitcoin and crypto especially. Some think that the rate hike fears are already priced into the markets, and others are calling for a completely destructive sell-off across crypto markets, sending us into a full-on bear market. Not to mention the fact there's so much uncertainty and skittishness in the market about whether war is going to break out in Eastern Europe. It really just feels like things are on the edge at all times. We don't know where it's going to go. Now, if you compound the effect of these potential rate hikes and potential global conflict with the growing fear, uncertainty, and doubt wrought by the accelerating pressure on the regulatory front, the outlook just looks even more and more alarming. Reports have been swirling for weeks now that the Biden administration in the United States would be releasing an executive order on the topic of cryptocurrency and regulation therein, which for many brings this deep-rooted fear that regulation is coming to crush large swaths of crypto-native components like stablecoins, DeFi, etc. Now, I'm no policy expert, and I've made that very clear, but I do want to quell some of the concern with this one, because if my experience is any indicator in the past, this executive order will likely just contain a call to action for various agencies in the government to do research and make their recommendations as to what policy might be. And then rulemaking is going to happen. It won't be this sweeping change on its own the day of the executive order. At least I don't think so. As it stands, the Treasury and other related agencies are still the main rulemakers here. And this is one that we're going to have to wait and see, but it's not one we should be panicking about, at least not yet. The fact remains, though, the next few months will be make or break for crypto in the wake of all these circumstances. And if we see prices holding strong in the face of rate hikes and regulatory scrutiny, it could bode well for 2022's crypto markets as select crypto assets start to capture their place as a store of value. But the more likely outcome is the opposite, if you ask me. Last week, I laid out the scenario, albeit unlikely, that crypto flips the script and ends up doing well this year after all, becoming a store of value, being a hedge against all this uncertainty, but I think it's not probabilistically likely to materialize. Which begs the question, how can you prepare yourself for this make or break period to minimize the impact of the downside while maintaining exposure for both midterm and long-term upside? So here's what I did. And this is not financial advice, by the way. This is just what I did with my own portfolio. Your mileage may vary. First, I looked at my expenses and what I need to survive, because if the markets end up down 80-90% off of all-time highs, I don't want to be forced to sell out of positions that I have long-term conviction in just to pay a bill. With that number in mind, to cover my mortgage and my other basic living expenses, I started trimming off any altcoins that I have in my portfolio that I didn't see meeting the following criteria. The first one was that the altcoin's current state of development was no longer exciting for me. If that's the case, gone. And two, the altcoin's price outlook for 1 and 2 years out didn't look that positive to me. So when I sold those, the proceeds from those altcoins, whether I took a loss or gain, went directly into stablecoins like USDC, which I placed into Ledn and Celsius to earn yield on. Now, that move is not without risk, of course, given regulatory uncertainty and lending and all sorts of stuff that can go wrong. That's a risk I'm willing to take. You might not want to take that risk, or in your region, it might not be available. To each their own. But for me, I'll take the stable yield and I'll take the risk. Those stable coins that are earning yield will be part of my emergency fund, protected somewhat from inflation in the event that markets turn for the worse and I need that money to fall back on to pay for life expenses. Now, if you're not adhering to the at least 3 months of fixed expenses savings rule, you're making a mistake in my book. I know a lot of people go all in crypto, but I think you always got to have a nest egg. I'm all about investing, but not at the cost of having an emergency fund to keep you afloat when things aren't going well. Anyways, with my portfolio trimmed down to only blue chips like Bitcoin and Ether and high conviction altcoins that I want to hold for at least another year or two, I'm ready to brave whatever the market throws at me price-wise. If it takes 2 years to get back to all-time highs or longer, I'm fine with that because my normal lifestyle is going to be covered and I've pulled off the table any profits and low conviction investments already. Not all the long plays are going to be winners, and that's just the way it goes, but that's perfectly fine. Now, the final element of this strategy is, of course, finding the areas that those long-term holds that I'm keeping can earn yield for me over time, even when prices are down. For example, a bunch of my long-term holdings like Polkadot, Cardano, Cosmos, Elrond, Near, they all have native staking that I can do from cold storage, at least for the most part, which helps me grow my positions over time. So you can think of my strategy like building a proverbial Noah's Ark. With Hashoshi's Ark, I'm prepared for a mighty storm of a bear market that I can sail to safety as long as it takes. But if the bear market never comes, and that's fine with me, I have a really badass ark with all my favorite coins on board still. And biblical metaphors aside, this strategy checks all the boxes for my own personal situation. I have plenty of stable capital on the sidelines for emergencies, for buying opportunities both in and out of risk-on lending environments, and I have plenty of exposure left over for surprise returns to bullishness. So it's a balancing act, and you know that I will be constantly adjusting as conditions change in real time. I'm a planner. So would it be helpful for me to do a video on how I kind of calculate and how I decide on these things? If that's the case, let me know in the comments. Now, next up, but kind of semi-related to the main topic that we just discussed, is actually some rare good news in the regulatory and policy side of crypto. Now, for context, a while back, I had covered a rather calamitous inclusion in the U.S. infrastructure bill that, as written, could have given the U.S. Treasury Department the ability to treat stakers and miners and validators, developers, and other entities in the crypto ecosystem as brokers, which would require them to meet reporting requirements that would be simply impossible for them to comply with, thus crushing crypto. This prompted a lot of response from lobbyists and citizens in the US and outside of the US, and it seems that effort has helped because the Treasury has communicated a rather promising clarification on how that language will be applied into formal rulemaking. Based on an alleged letter to members of Senate, the Treasury indicated that parties unable to reasonably comply with broker reporting requirements like crypto miners and stakers, hardware providers and software providers, developers, will not be held responsible. Now, this is progress, but it's not perfect, and I haven't seen the letter, so I don't know for sure what all of these things are. But the letter also indicated that the jury is still out on the treatment of decentralized exchanges and peer-to-peer exchanges and how they will be looked at in terms of compliance with these rules. So it's not 100% clear, and requiring decentralized exchanges to provide reporting would be a pretty big problem. So this is going to have to develop as time goes on, but based on the reports, if they're true, and hopefully they are, this is maybe one step along the way to regulatory clarity that's both kind to innovation and tough on scammers and criminals, because there's too many of them out there. In other news, the Algorand Foundation announced that it would be earmarking $20 million in funding via grants for developers that contribute to making the Algorand execution environment EVM compatible. In other words, to push the Algorand ecosystem into allowing the use of Ethereum smart contracts written in Solidity to execute on Algorand's network. And half of that $20 million in grants will go to developers that are directly contributing to solutions to make Algorand EVM compatible. And then the other half is going to go to developers who deliver useful developer tools to make the holistic experience of building on Algorand easier and more efficient. And so this, to me, is the right move for Algorand, in my opinion. We're entering into a builder's period here, and I think that history has shown that every single L1 network should be prioritizing EVM compatibility at the base layer or at the layer 2 from the very beginning. And there's already such a shortage of experienced developers in this decentralized app space, and the whole idea that if you just enable existing languages to be used for smart contracts, that suddenly developers are going to come out of the woodwork, it just hasn't materialized that way. So moving to support EVM compatibility on Algorand can help it maintain the momentum it has and push further into the DeFi space, which it very much needs to do. Now, I want to take a minute as well and talk about Cardano, which I haven't talked about in Crypto Over Coffee as much lately. Cardano is one of those polarizing projects, about as polarizing as you can find. You've got one side who thinks it's a complete scam, and then the other side thinks it's the best thing since In-N-Out Burger. And the word scam is pretty much meaningless in crypto now, so there's that part. But you may not like Cardano or agree with its design or design principles that have caused it to be very slow to market, but it's not a ghost chain or vaporware like its vocal critics would say it is. And there are a couple reasons why it shirks both of those definitions. First, Cardano has had the highest on-chain adjusted transaction volume and been in the top 5 of non-adjusted transaction volume countless times in 2022 alone, with an average fee per transaction reportedly under about 50 cents. In the last 24-hour window that I checked before filming this on Messari for on-chain data, the adjusted transaction volume on Cardano came out to a total of over 20 billion. So I'm sorry, that's not a ghost chain. Secondly, with only a few major DeFi applications readily available on mainnet and out of testnet today, as the developer community is kind of feeling out the new design paradigms, Cardano already has hundreds of millions in TVL, sitting at nearly 130 million. Now, is it anywhere close to Ethereum and others with much more mature DeFi environments, especially EVMs? No, but it's also far from a ghost town in the DeFi landscape, at least far from the ghost town people make it out to be. Some of the bigger projects poised to launch here shortly, like Liquid Finance, for example, will bring a cascade of liquidity to the mix, and this number will grow. Also, how about the Milkomeda, the L2 for EVM compatibility? Anyway, the point being, you're free to hate Cardano if you want. It's a free world from my perspective, but at least be realistic about what you're criticizing. Now, it is time for Rational Reactions, a somewhat new segment on the show where I read headlines from tech and crypto-related publications and give you my instant reaction to those headlines. So let's switch over to the computer and we will go ahead and get started with Rational Reactions. All right. The first story, and I didn't mess it up that time. I was being deliberate in not saying the first question. That's for later. The first story of the day is from Cointelegraph. Actually, I think all of these are from Cointelegraph today. I just found quite a few that I liked here. This story headline reads, "Crypto is like a, quote, venereal disease and should be banned. Charlie Munger." Comments made by Warren Buffett's right-hand man and vice chairman of Berkshire Hathaway have gone viral for their imaginative depiction of cryptocurrency. Now, I wouldn't have pegged Charlie Munger to be a person who can relate to the idea of a venereal disease, but that's neither here nor there. The reality is comments like this are rather comical, because when you take the time to verbally and publicly bash something like this, it really seems to the external party, to the third party who doesn't already natively agree with you, to the neutral party, it might seem that, why does this person hate it so much? It seems like they're a little threatened by it. And I really think that that's what this is. I really feel that Charlie Munger just maybe doesn't fully grasp what's going on, or maybe is just completely anti the idea of crypto because it's so far away from the world that he's made his money in. And that's perfectly fine. We don't need everyone to be a fan of crypto. And quite frankly, I don't mind the fact that not everyone is into crypto. I think that's actually very good. It's good to have those critical views. The issue that I have is it's like just immature and like really kind of ridiculous to say that crypto is a venereal disease. And I think, based on my knowledge of past comments, this is not the first and not the last time that Charlie Munger will have said something very off color and frankly kind of disgusting and disrespectful about this space. But regardless, I think that this is just another instance of, a person who trains horses saying that cars will never work. That's fine. Whatever. It is what it is. The next story is from Cointelegraph again. US-based crypto firms join forces for travel rule compliance. We, adding new members so that Trust can provide comprehensive compliance across the crypto industry, said the joint announcement. Now, just for a little bit of context, the travel rule is a very well-established sort of regulatory framework or requirement for financial institutions to share information about the people who are transacting in their organization sort of across the institutions. There's always been this concern that the travel rule would be applied to crypto, meaning that you would have to share information from exchange to exchange and even potentially DEX to DEX. And so I think a lot of centralized exchanges and a lot of these sort of bigger crypto companies have banded together to come up with a mostly privacy preserving way to adhere to the travel rule to eliminate money laundering and other financial crime, which is really what this is focused on. The problem with the travel rule in the past is that it is just a privacy nightmare. You have institutions just sharing information, personal information relatively freely. And I'm not a travel rule expert, so let me just make that very clear. But I think that this crypto firm work right now around this trust framework is actually not horrendously a bad thing, not unilaterally a bad thing. I think people are going to say that it is, but I would rather these companies be creating this than traditional finance people be creating it, because at least these companies kind of get it. So we'll have to be cautiously optimistic on this, but I actually don't think this is terrible news, even though some have reacted very negatively to that news. And the last story that we have on the books today is the Bitcoin difficulty reaching all-time high. Hash rate up 45% in 6 months. The Bitcoin network has hit another all-time high in terms of difficulty as competition among miners intensifies. Now, if you look back at history, pretty much indisputably, pretty much consistently, when Bitcoin's difficulty has reached all-time highs and hash rate has reached all-time highs, which of course drives the difficulty, the more competition, the more hash rate in the network, the higher the difficulty goes to sort of balance the incentive. Now, whenever that's happened in the past and we've reached new all-time highs, all-time high prices have followed. Now, we've started to see a sort of breakaway from that pattern in recent months, maybe even a little longer than months. It might even be close to a year. What's interesting to me is to see if that pattern continues, and if hash rate continues to go up and up and up and up and up until we reach this equilibrium point where price and hash rate and difficulty and the cost of mining Bitcoin is so widely different than the price of Bitcoin, because we're eventually going to hit that point where it's not economically viable for all these miners. Now, what's really interesting is that this would normally push the price up, but I think given all the stuff that's going on that we talked about today, the price is not going up despite all these new miners coming online and more hash rate coming into the network. This is an interesting metric to watch. It's not a 100% indicator, but one that I'm very curious to see, because this is one that I was very surprised to see sort of break away and decouple from Bitcoin price as much as it has in recent months. So that's definitely one to watch. That being said, Please stick around, continue watching, continue listening, because we got 404 Logic Not Found coming up right now. Now, ladies and gentlemen, like I said, it is time for 404 Logic Not Found, and for those of you who are as of yet uninitiated in this little firecracker of a segment, I highlight notable tech-related fails or otherwise stupid moves in the world that need to get some attention. And if you like 404, make sure you hit like, get subscribed, follow the podcast, whatever you can to get the word out. Thank you for that in advance. Now, I think you can probably all guess where my consternation lies this week, and that is none other than the absolutely horrendous happenings in Canada. Quick beer break. Now, to give you a bit of backstory, for a while now, a group of truckers and those supporting them have been protesting in the nation's capital, Ottawa, and there's been a stalemate between protesters and the government for a pretty good long while now. Now, as part of the protest, the truckers have reportedly more or less blockaded portions of the city, disrupting travel, including to and from the US border. Now, in response to this ongoing protests, Canada's leadership decided to invoke the Emergencies Act, which granted special emergency powers to the government to effectively compel financial institutions to cease relationships with those directly or indirectly involved in these protests. Now, this goes a step further than what I can read as the original scope of the act, which was originally designed to temporarily cut funding measures for emergency disruptions to public order akin to the bad word, terrorism. Now, I get the definition may be up for debate, but the fact remains, I find it rather disconcerting that a reportedly non-violent protest with seemingly zero diplomatic engagement between parties has resulted so quickly in financially ostracizing anyone who is directly or indirectly involved, all the way from protesters and presumably to those who just simply donated money to support them. No matter what side of the protest debate you're on, that is a draconian and arguably unconstitutional move to either temporarily or permanently revoke a citizen's access to financial services. I mean, in many countries, most if not all felons can open a bank account, for goodness sake. The common argument is that because the protesters blocked borders and critical infrastructure, that it was adequate grounds for the Emergencies Act's invocation. But based on the reports that I've been able to find, and I'm happy to be proven wrong, those border blockages and other instances that were concerns were resolved without violence before the invocation of the act. Now, that's what the police are for. If protesters are moving outside of the boundaries of protest and breaking laws, you send the police to deal with those incidents and resolve them in isolation. You don't create a political vacuum in which to excommunicate all citizens that don't agree with you from a critical part of society, that is financial services, and are exercising that right. Now, I'm no policy expert, I've said it already today, but I truly do not see any grounds in which this act could have been invoked reasonably, at least after the border blockage was cleared. I mean, that I get, that's an issue. What's most distressing about this is that there seems to be no attempt made to have a dialogue with protesters to understand their feelings and their side of the argument. Whether you agree or not, that should be prerequisite. And secondly, if the reports are to be believed that little to no violence has occurred and border blockages were quickly resolved, why was the Emergencies Act invoked in the first place? And for those siding with the government on moral grounds right now because you disagree with the protesters' views, listen, that's within your rights. But I implore you to think about it this way. What if the other side of the political spectrum was in power and you were protesting what you believe to be in violation of your rights and or beliefs, and this same Emergencies Act revocation of your financial relationships were brought against you? I don't think you would feel the same way about this, would you? I mean, that's the 404 here. It's not about whether the protesters were right or wrong. It's probably like any other protest. Some took it too far and some didn't do really anything wrong except be in the wrong place and disagreeing with a large majority of people. But it's about the fact that the Canadian government did not do enough to exercise leadership here, at least in my opinion, and instead used the most draconian measures that they could muster to snuff out opposition to its recent policies. And to me, that's wrong. As a leader, you have to be held to a higher standard in how you engage and listen to your constituency. And this was way below that standard from my perspective. And you may share a different perspective, and that's totally within your rights. But to me, this was a 404 Logic Not Found without a shadow of a doubt. Now, my friends, it is time for sponsor time, which helps me keep my coffee cup, or beer in this case, full, and this show coming to you every single Saturday. Now, last week, I shared with you the awesome announcement of the Cryptoverse, the metaverse project built by the team behind Chain Guardians and Chain Boost. This week, I want to talk more about their virtual land offering, which I know many people are pretty darn into right now. The metaverse is very hot and land is very hot. The Cryptoverse map will be populated with 8 distinct island zones on which land can be purchased in an upcoming public sale event due in March on platforms like Polkastarter and Chain Boost, among others that are yet to be announced. Within these island zones, there will be specialized areas with different themes and attractions, but more importantly, owners of digital land in the Cryptoverse will be able to build their own experiences and content inside the virtual world. No real surprise there. Now, the land itself is divided into 2 main categories: estates and parcels, where parcels are individual plots and estates are sort of bundles of those parcels that make up one cohesive plot of land to build on. Now, this is intended to make land accessible and customizable for a variety of different use cases. Users will also be able to choose the zone or island where their land is going to be, which gives people customizability as to where they will be located in the Cryptoverse. Now, I'll reiterate that based on the renderings that I've seen, this is not a drag and drop metaverse with standard assets. The designs are pretty incredible, and I can't wait to see how it turns out at launch. But please remember, this is not a call to action to buy tokens, virtual land, or anything like that. Please be safe. Okay, let's do some community Q&A. I always answer questions from folks who watch the show, and I've got some questions from last week's show that I'm going to answer. And I want to remind you that if you have a question that you want answered, beginner questions are fine, advanced questions are fine. Leave them in the comments on YouTube, or you can tweet me at Hashoshi4 because I also check there for questions. All right, let's dive into them and get started. Now, we had a lot of questions in the last show, but I could only grab a couple because we are running tight on time. I'm trying to keep this close to 30 minutes per your feedback. What do you think about crypto nodes and master nodes? This is a question from Jean-Philippe L. Do they always provide real value to the blockchain? At least not in the way they seem to provide return to investors. Having a hard time wrapping my head around how people are making thousands of dollars per day with nodes when these nodes don't bring any revenue by mining. So master nodes are this interesting thing. The problem with master nodes is they're often not economically viable long term. And in the cases that they are, it's because it's reliant on sort of the continued growth of that ecosystem and maybe an internal treasury system that's driven and funded to pay out these master nodes for whatever process they're actually facilitating. Now, the biggest issue with master nodes from my perspective is that they are putting you in one particular risky situation, which is that you have to buy in to have a master node. There's often a big buy-in in terms of token volume. So if you get in early, you can get in for a low denomination of fiat currency, whatever you're measuring value in, and that's great. Okay, fine and dandy, you start to generate returns, but you're kind of locked in there, right? So if the price of that cryptocurrency that you bought to get into the master node tanks, you have huge exposure to that, and you're earning rewards in that as well. So all of that exposure puts you at risk. And the same thing applies for people who buy in later on, not even buying in early, but buy in at higher prices, especially. They're taking on this risk. They're looking for the yield. They're looking for the returns. The underlying cryptocurrency in the ecosystem absolutely tanks. You've got a lot of exposure and you get wrecked. That is the reason why it's very dangerous. In terms of how you generate yields, there's a variety of different ways. Oftentimes it's treasuries. You might have a sort of like a cyclical economy where you have fees and other things going to pay master nodes. Sometimes master nodes actually do have a function in the network. There are varying ways. In my opinion, I stay away from them. It's not my thing. I don't want to have to buy my way into huge exposure. I'd rather just stake my cryptocurrencies on networks I like and just call it a day. So that's my thought. Next question is from Edwin Tax. Do you think there's a place for NFTs without utility, more focused on art and history/education, like Cardano Combat? Now, NFTs are a polarizing topic because some people think NFTs are just bits and bytes. They're totally useless. Even if they have utility, they're trash. I don't agree with that statement. I think there is digital art that is a great example of irrevocable, easily provable, one-of-one pieces of digital art. The problem is the ecosystem is not yet developed or mature enough to prove and verify and govern that process. of making sure that it's not easy to copy, making sure that you buy something that you just are told are one of one from this artist and has actually been reminted by someone else. So there's going to have to be, digital identity attributes. There's going to have to be reputation systems and other sort of mature ecosystem developments that are going to make digital art a more viable, long-term, less cash grabby environment. But art is subjective. So what looks like garbage to me might be a masterpiece to you. And so if you buy that, there's probably someone else in the world who loves that the same way as you and wants to own the one of one. They want to own the original. And just because it's not tangible, people have a tangibility complex, doesn't mean it doesn't have value. What you have is a certificate of ownership, a certificate of authenticity that's signed digitally by the original artist that says you are the owner of the original, regardless of how many people have copied it. So I've been through this several times on the channel, so people probably get sick of hearing it, but I do think there is utility for digital art. But to really get to that next level beyond pure speculation, we're going to need maturity in the technology and the ancillary services around the digital art space to make it more effective, because it's not going to become mainstream using OpenSea, for example. So with that, folks, that's going to do it for Crypto Over Coffee today. I want to thank you so much for watching. I know it's getting a little dark because I'm losing sunlight. I use my window at this place, this temporary studio at my in-laws' place, in order to actually film these videos. So I'm losing sun. But anyways, thank you very much for watching or listening to this episode of Crypto Over Coffee. If you have some time to stick around, please check out my recent cryptocurrency video. I'll link it up here on the screen. Most of all, I want to wish you and your family a wonderful week and weekend ahead. And until next time, cheers.